how are people thinking right now and how should they be thinking? And that's what I want people to really grab from this. Okay.
Yeah.
Um, cool. Todd, is there anything you want to say? If not, I'll jump in.
Yeah, no, I mean, I think, high level, I would just start with, taking a 30,000 foot view of the market because, um, real estate is a cyclical business and it's been pretty rough over the last, couple years. And so I think, setting the stage so that people are coming in with the right expectations is probably the first and most important thing to do. And I'm going to share my screen for a second just to give some real context here. And so, here at USDV, we keep a database of the market. And as we look at the market, these are the loans of the top 37 lenders across the country over the last 5 years. And specifically, we're looking at lenders who are doing business purpose loans, so ground up construction, fix and flip, um, Airbnb, short-term loans. This does not include long-term loans so much, but as you look at the volume here, you can see that we've definitely have had some peaks and we've had some valleys, and we probably hit a peak here somewhere in Q3 of 2025, but then it really has fallen off since then, and so and prior to that most recent data, it was pretty anemic, and so I share that because sometimes we can feel and get down on ourselves because maybe there just aren't as many deals. Are you doing something wrong? Is there something else happening? But overall, the market is just down. And if you carry this over to just total mortgages, specifically as it relates to home loans, you can see mortgage originations over the last 5 years. You know, it really, fell off tremendously from, in 2021, about, 1.2 billion mortgages down to, 300 and, 23 billion mortgages. So, in dollar value, I should say. So, so here we have what 1.2, so that's what $1.2 trillion worth of mortgages in this one quarter, all the way down to 300 billion. So like the market is starting to recover a little bit. So I think we are starting to see some positive signs as it relates to maybe a little bit of a recovery. But with everything that's going on with the war in Iran and oil prices going up, I think there's still going to be a lot of hesitation around how much people are going to be willing to invest and are they going to have the confidence to take that next step. So I think we're going to be in a tough situation probably for the next, 3 to 6 months at a minimum. But I will say it seems like we've kind of turned the corner from being at our lowest point in 2023 and kind of starting to come out because, the home market really drives the investment market that we are involved in. And so many times you're going to see builders, you can see we probably hit that trough in 2023. Maybe builders started to get really happy thinking, hey, we're coming out of this, let's start building more. But it's now fallen back off of a cliff because that has not occurred yet. And so I think, builders, our market here in the private money market is going to try to be slightly ahead of the consumer market, but the home, because they need to deliver these homes when those consumers are ready. But you can see, I mean, we probably can be doing 3 times as many mortgages as we are. So there's a lot of room to grow, a lot of room for upside, but we're just not there at the moment. So I just like to lay the backdrop because sometimes we can beat ourselves up thinking that we're doing something wrong. And there's just overall a really, difficult market that we're in. And so, what we've done here at USDV is taking the time to like focus on building our systems, getting things in place so that as the market does turn, we're in a better position to do more business, and not just bury our head in the sand or take a vacation or complain about the market, but just say, hey, what can we do to be prepared for the next cycle? Because that's one thing we do know is real estate will go in cycles, and so I'll kind of start us off there.
Oh yeah, that's good. And it's good you brought up it puts things into perspective so people don't beat themselves up and say, why is business not good right now? Or why can't I,
Yep.
get things moving? And then it allows them to focus on, oh, how can I stay ahead of when you see it working in the cycle? It's like everyone
Yeah.
can look back and say, oh yeah, I can see why that was that way in 2021, or oh yeah, that's when my business was hit in 2023. I
Yes.
wasn't the only one. I'm talking to my friends and they're running into the same issue. So
Yeah.
I think that's really key is when you bring it up like that, it can allow people to just really stop and take a second to say, all right, it's not just me,
Hmm.
whether I've made mistakes or not. It's like we're learning the market, we're dealing with the cycle, and anyone who's been in this business for quite a while will know like these cycles are just they're part of this, and it's important to be able to weather that.
Yeah.
No, that's great. I wanted to put some of the questions here in the chat for you to see, Todd. Um,
Yeah.
but like one of the ones is like you've been talking a lot about seeing capital as an asset for people, right? And
Yeah.
so one of those questions came up is you talk about how the biggest players, they see capital as a utility rather
Yeah.
than a hurdle. And so
Hmm.
for a builder that's used to trying to get lending off the street or traditional banks or whatever that is, you
Yeah.
know what's something that they can do? What's the first step that they can take in kind of making that shift to look at it this way? It's one thing to
Yeah.
say like, hey, capital is there, but when I'm knee deep in trying to figure things out on a day-to-day basis, it's hard for me to kind of grasp that. So I just want to get your thoughts on that.
Yeah, I mean, I think and I think this goes for just about anything in life. Step one is um, you need to be able to take the perspective of the person on the other side of the table, because once you understand their perspective, it's going to give you a lot more insight into what needs to be done on your end. So that could be a relationship with your spouse. But being able to obviously understand where they're coming from is going to help you respond in a more appropriate manner. And so, we have a core value in our company, which is called seek first to understand. And in the same way as a borrower or a real estate investor, I'd say, hey, how can you seek first to understand what it looks like to raise capital from a lender's perspective or from an equity investor's perspective? And so, once you start to do that, you'll realize a few things. Number one, I was always surprised when I heard lenders use the phrase that they sell money because it sounds so weird. It doesn't compute in my brain that I sell money. But in reality, lenders are paid to lend money. So their product is money. And so I think that kind of goes right into your term that you put, that's in the chat, which is, utility. It's a utility. It's something that needs to be utilized. And the bank's product and the investor's product is their money. And so what I found is whether you're a bank or you're an equity investor, there usually is a fiduciary responsibility or a feeling of responsibility to say, I need to do something productive with this capital. And so how am I going to be productive with the capital? And so I think that comes in two forms. Number one, you need to find someone trustworthy to put that capital with. Number two, am I going to invest with them by lending money, or am I going to invest with them by co-investing and being an equity partner? And those are two very different approaches. Lenders are typically going to be more conservative and they want a lot more risk protection. And equity investors are going to be more aggressive, but they're going to want a much higher return. And so, as you just step back and you say, hey, let me look at the world from my investor's point of view. And when I say investor, I would consider both your equity investors and your banking partners or lenders. They're also investors. Remember, a bank doesn't make money just by you paying the interest and their origination fees. They only make money once that loan is paid back. So until that money gets paid back, they have not made any money, to be quite frank. And so you really need to think of your investors or your lenders as investors as well.
Awesome. Okay. No, that's wonderful. I think that's a really good insight to get people to really think about the how the bank is actually making money off it, which
Yeah.
also shows the incentive for the lender to want to give the money, right? I think sometimes people can get caught up in, some guys are like, hey, I don't this guy's stealing from me. This guy's just trying to make money off me or trying to make his origination fee or, this banker's trying to do something or trying to work one on me. And it's not really the case. The bank is going to make the money off. It's an institution, right? They're going to make their
Yeah,
money off of the loan being paid, and I think that's an important concept.
yeah, absolutely.
I got this other one here that I'll put in, but going based off of what you showed actually in the dashboard, just showing the cycles is,
Mhm.
how should, a developer adjust their exit strategy when they're taking on short-term debt right now?
Yeah, I mean, I'd say two things. Number one, I think you know this is another reason why you want to have both um, equity partners and debt partners because debt obviously requires current payments, and so when you're building or developing, there is no cash flow until that property's finished, meaning until you can either sell it and get cash or you can rent it, there is no cash flow. So it's a time where those with equity will have an opportunity to grow while those without equity are going to be stuck. Um, Number two, I'd say you want to go into deals a lot more conservatively and say, hey, my exit may not be that I'm going to be able to sell this property after I build it. My exit very likely may be that I need to rent this property at the end. And so I'd say the exit strategy needs to be, let me take a conservative viewpoint up front, and then model that. And I think there's two things to really model. Number one is modeling the um, the rent that you're going to get, but then also knowing like if you don't sell the home brand new, but then you rent it for 1, 2, or 3 years, you're probably going to have another renovation that needs to be done prior to selling that home. And then when you do sell it, even though it'll be like new, it won't be new. And so I think being aware of that is really important.
Mm, okay. All right. Here's another one, Todd. Can you explain the mechanics of a revolving credit facility? And ideally for, a builder who is trying to sort of move like the way a cash buyer would, meaning like, they don't have a lot of money in the bank. They're trying to figure this out. They're trying to, stay afloat and they're trying to keep it moving. I don't know if you can just walk through. I know that's a really, really, really big topic and it's something that you specialize in. People have heard you talk about, but I just want to see if you can kind of scratch the surface a little bit.
Yeah, so think of a revolving credit facility as very similar to having a home equity line of credit on your home if you've ever had a HELOC. Um, it's a credit card, um, and there's some collateral for that credit card, and so whereas a credit card is typically going to not have any security interest, your HELOC does, right? So you can borrow against your home. They're going to set a value for that home. They're going to say, do you have a first mortgage or any other debts? And then we're going to give you a loan up to this amount of money. You can draw from it, you can pay it down, and you can draw from it again after you pay it down. And a revolving credit facility is exactly the same as a HELOC, except instead of there being, one property, you're typically going to have multiple properties that are collateralizing or being a security for that debt. And so it's a great way to grow your portfolio because now you have the ability to draw against those properties as you need to. And so I'd say the thing that's really challenging is for real estate investors, there hasn't really been a HELOC solution for commercial slash residential property investors where you can just get a HELOC, so to speak. And so what banks have done for clients who are, I'll say, larger, and by large I mean typically portfolios at maybe $10 million or more, maybe you can find somebody that will do something $5 million, but typically it's $10 million or more. You can now take that portfolio, pledge it, and then recycle that cash. So that's it. It's just another tool that will allow you to grow in an environment that many people just don't have that resource available to them. So that's something that we help our clients with as well.
Awesome. Okay. And then I think that works for this next question as well that you can touch on is like, okay, so if I'm a developer and I've hit a plateau because of not enough cash on hand, is private capital or a revolving credit facility something that can work for that?
Yeah, I mean, I'd say two things. One, it may be tough as when we say the word plateau, like where what plateau really means. Like, is it that I need more capital to grow and I have a lot of equity in my properties? That's one kind of plateau. Another plateau is, I'm in the middle of a bunch of projects and I ran out of cash, right? And so I think those are two different plateaus that people hit. If you are a property investor and you have a lot of built-in equity in the properties, then yeah, I think a revolving credit facility is something that would be worthwhile pursuing. I think if you're in the middle of a bunch of construction and you don't have the equity, built into the properties just yet, then now you really need to probably find equity capital before you go seek a revolving credit facility. So I think those are two plateaus that I see, developers running into. It's either they have equity tied up and they need to access it, or they need more cash to keep going, at which point they really need to find more equity partners.
Yeah, okay. And so this next question is really, how does
Yeah.
someone go about finding equity capital? I think you're just
Yeah.
trying to find a sequence here.
Yeah, absolutely. I think that's a great question, and it's one of the things that I've spent a lot of time, working on and teaching over the past 2.5 3 years. After having done 8 funds, my primary objective has been to raise capital to then deploy that capital, and so over the last 2.5 3 years, I started teaching real estate investors how to raise capital. So we have a program called the Capital Raising Blueprint as an example. You don't have to use my course, you could use someone else's. But the idea behind this is like you have a vision and then you need to raise capital. And so our goal is to really empower you as a real estate investor to go out and get equity capital on your terms. And so what did that involve? That involves, you know, I think a couple of things. Number one, just addressing the fact that it's hard. It's a real difficult thing to do. Probably one of the hardest things I've had to do. Number two, maybe you don't even have access to investors. Number three, maybe you don't have a good pitch deck or your pitch deck isn't resonating with investors. And then number four and five, it's like maybe you just ultimately feel like, hey, I'm wasting time and now I'm getting away from my core business of like building, developing, managing properties. And now I'm over in this space that I just don't really understand, which is like raising money. And so, what I'm encouraging our clients to do who want to be, you know, long-term investors in the space is to say, you're always going to need more capital. So build a strategy today that you can, constantly be in the process of raising capital. You're constantly looking for investors. You're constantly inviting investors to the table to learn more about who you are, what you do, because there's been a lot of I guess I don't know if they're technically scientific studies, but studies around if you were in a room of your target audience, people who are qualified to buy what you have, and you had 1,000 of those people sitting in front of you, you know, A, what would you say to them? But B, only about 3% of them are ready to buy now, right? So out of 1,000 people, that's 30 people. Out of 100 people, that's 3 people. And so I think there's a couple dynamics going on. Number one, even if you could get an audience of just your target client, only 3% of them really want to buy now from you today. And so what does that mean? That means I need to have a strategy to be available, to be top of mind, to stay in front of them with what I'm doing, who I am, how our projects are going, so that when they do have either the capital, the resources, or the time to listen and they want to invest, you're the first person they think about. And so um, I think that's number one. Number two, it kind of goes with number one, but finding money in motion. So it's just as important as it is to find the right person. It's trying to find the right person at the right time. So, just taking it old school, when we were young, especially, I remember my first job at Jack in the Box, and I got paid every Friday, right? And so it's better to catch me on a Friday on a payday if you're going to try to sell me something than catch me on a Thursday when I just ran out of all my money. Right. So maybe if I find somebody who just got a promotion on a job or they just sold a business or something, that's money in motion. And so finding people, not only the right person, the right people, but number two, finding that money in motion. And then number three, I'd say just taking a step back and saying, hey, how do I even identify the audience that I should be going after? And that's probably the hardest one. And that's something that we help you with. But you have to find an affinity group that is going to connect with you. I found my affinity group was first generation business owners who had some form of a liquidity event. And that was who resonated with me, that resonated with my story, which is maybe very different from someone who came from money and has a deep list of connections from their family, or they understand the dynamics of asking for money from a trust or from mom and dad or something like. And there's people who have that's a real struggle for them. That wasn't my struggle, but I think understanding your niche of who is going to resonate with you is really important. And within there, once you get that, like really hone in on that niche. I know one of a colleague of mine, he built the foundation of his business as a family office by working with dentists. And why did he do that? Number one, he was a dentist and he got tired and realized like he was never going to reach his financial goals being a dentist alone. So then he set up a company that helped specifically dentists. And then as you get to know, like, hey, dentists have unique challenges financially that may be different from plumbers, that may be different from other kinds of business owners. And now you're going to be speaking their language and you're going to be seen as a specialist in that community, which is going to then lead itself to getting more referrals and introductions because now you're going to be known as the person that helps dentists, right? And so I think those would be the three kind of keys that I would, focus on is number one, understand even if I did get my target audience, that people are not ready to buy today. So I need to have a constant and consistent outreach strategy. Number two, I need to really make sure that I identify, my niche of who I'm gonna really help. And then number three, I forgot it was number two, but I forget number two at the moment. But the goal here, I think, is just to say, hey, I have an audience and I have a niche that I'm specifically helping. Oh, and then finding money in motion. Like, okay, how can I make sure that that I'm targeting and addressing people who have money in motion? So that those would be the three ways I would go about finding equity capital.
Amazing. That was really, really good breakdown for people to understand. I think that the money in motion is a really, really important concept because I think people
Hmm.
wonder like, oh, why doesn't anyone want people don't want to invest in me right now, but it could just be just not you talking to people at the right time. A lot of that
Yeah,
has to do with it.
yeah.
Okay, there's just one more question here, and then we'll go ahead and wrap up. This one seems to be just a little bit more specific around loan products themselves. But the question is, if I want to get if I want to get loans to build new properties, specific, so new builds specifically, am I supposed to look at specific loan products like bridge loans or ground up construction, or is it more about what kind of project I'm doing?
Yeah, I mean, that's a good question. I'd say a little bit of both. So, you know, I'd say bridge loans typically are going to be for people who maybe have some equity in a property and don't necessarily need a rehab budget. They just need to pull out money to get a project completed. So, um, or a bridge loan, would be someone that maybe has a property that, is ready, it's listed, ready for sale. They need the money now, but that property may not sell for a few months and they want to go buy the next deal. And so they'll use a bridge loan. A ground up construction is what it is. It's ground up construction. And so I think at that point, you're looking at, a lender who is comfortable and happy with managing draws and understands your project, understands your schedule, understands what that looks like from a timing perspective, because draws add another risk to your business operation. So um, I think the type of project you do matters a lot, because when you get into a bridge loan or a construction loan, the biggest question that a lender has is, how are you going to pay me off? Right. And so let's say I'm doing a build to rent strategy. Well, I want to make sure, if let's say the loan that you get for your long-term rental loan, let's just use some round numbers for a second. Let's say I I buy a property for $300,000, and I put, you know, $300,000 into it. So I have $600,000 into this property. And at the end, it's going to be worth, let's just use a round number, $1 million. I don't think you're going to get those numbers, but let's just say it's worth $1 million. At the end of the day, if you were going to rent that $1 million house out, what is the rental income? What are the insurance? What is the insurance? What are the taxes? Is there an HOA? And ultimately, what does that why do I need to know those numbers? I need to know those numbers because that's going to determine how much the lender is going to give me at the end for a rental loan. So maybe, the terms on a rental loan may say we'll go up to 80%. So in your mind, you're calculating, hey, it's $1 million. I'm going to get $800,000. So borrowing or getting, spending 600,000 between my purchase price and my construction budget, I have this $200,000 worth of cushion. But in reality, let's say the property can only debt service $600,000, right? Meaning, like, just once you take the rental income, you subtract out your taxes, insurance, HOA, maintenance, etc. There's very little left over. So if the final loan at the end is going to be 600,000, um, now that lender who's putting a loan package together needs to say, hey, I need to make sure that I'm lending less than 600,000 total on this project, because that's going to be the final loan amount. So you can understand, like, if your exit strategy, it kind of goes back to one of your first questions, or one of the first questions in the group, which is, if your exit strategy is buy and hold, a lender needs to look at it differently than if you said, hey, I'm going to do a buy and sell. Because now, let's say that property would sell for $1 million. Well, that's a completely different story, because now maybe I'm willing to give you more than $600,000, knowing that I don't have to worry about takeout financing. And so that would be where the kind of project you're doing matters. And I know we just use like a single family house, but obviously it gets very clear whether, if you're building an apartment building or some other structure that is dependent upon some form of takeout financing. And then it's like, okay, who are those takeout financiers? So I would say the key is going in with the end in mind, saying, hey, where am I going to end up at the end? I would say in this market, I would go in with the end in mind being the more conservative exit. So, hey, homes have not been selling very quickly, especially in certain markets that we've been heavy in, Florida, Texas, et cetera. So if you're in those markets, you probably want to, make sure that you're positioning yourself for maybe a rental strategy that takes less debt, requires more equity, but puts you in a position to still be solvent and win, versus maybe if you're in the Midwest, Dayton, Ohio, as an example, is, I think they're maybe up 7 or 8% year over year. So there are markets where the market's going up, and maybe that's a market where you don't want to rent, you just want to sell, and you can be a little bit more aggressive. So I'd say, just like any other business, know your numbers, know your market, and also don't think that your market is the end all be all. Sometimes, maybe you need to go find a new market that is going to help you if your market doesn't support what you currently do. And I would just encourage anyone who steps outside of their market, maybe identify a local partner that can help you know that market much better, whether they're an equity partner or even a lender. Many times I tell people, the good part about having a lender, if you're new to this business, is the lender wants to get paid back. So they're going to ask for more things that you, as a new investor, may not know. And as much as it costs you money to take a loan, many times your lender can be one of your best advocates to make sure you stay out of trouble, because they're going to make sure you have proper insurance. They're going to make sure you have a proper title policy. They're going to make sure all these things that protect them, they naturally protect you as
Mm.
well. So
Oh yeah, that's good. I think you hit the nail on the head there. That's really key because it puts into perspective that the lender is on your side.
Absolutely.
It's not me versus them, which I think in somewhere someone's teaching that to
Yeah,
people. And I think that's
absolutely.
counterintuitive to just business as a whole. It's like everyone's working together, everyone makes money together. There's more than enough to go around. Everyone's designed to protect each other, through the process. The lender's also for advocating for you, as they're going to get the financing for you. And I think that's really key. And that's why it's good and you said this in the past, we didn't really talk about it so much today, but it's like, it's really good for when the developer or the builder is focused on their craft. They're
Hmm.
focused on their craft and they know what they're doing and they just want to get this project going. They just want to get this moving forward. And
Hmm.
by having someone in their corner that can help them do that, I think that's really key. And that's what people are looking for. That's
Yeah.
why you said this, and we won't get too much detail about it today. Maybe next time. Maybe we'll make that the topic of the next week. But you say it's like if everyone only cared about the rate, people
Yeah.
would waste time just shopping around for rates, but they're not looking for that.
Absolutely.
They're looking
Yeah.
for someone that they can trust is going to help them and through the situation. That's really the biggest key. Otherwise, like it's like um, the rate talk is like really good clickbait and rage bait for people,
Yeah.
But the reality
Hmm.
is, it's like most people who are really doing incredible work, they're not focused on that. And that's a
Yeah.
big, and we'll probably talk about that one next week
Mhm.
because that's something that seems to be like a daily conversation for everyone is what about the rates? But you
Yeah.
you just
And
you just said it, which is someone's going to be in your corner to help you
I
through
think
it.
that's a great point. I mean, I just while you mentioned that, I just looked up, it says there are over 5,100 financial institutions that report mortgage lending data. So when you think about that, like if rate was the most important thing, why would we have over 5,100 lending institutions, right? Because, you probably only have a handful, the ones who do home mortgages, the ones who do commercial mortgages, the ones who do, small business loans and some equipment loans, and then that's it, right? But it's like 5,100, and that doesn't even include all the private lenders that are in the space than our space, right? These are regulated financial institutions. And so I would just say, yes, you're right. I mean, rate is definitely not the most important thing. It's clearly a factor, but I'd say more than anything, like think of your lender as your partner, as your investor. And if they're not treating you like that, find a new lender.
Yeah, that's I think that's really, really important so people know that they have someone in their corner that's gonna
Absolutely.
guide them along the way. Awesome. All right.
Absolutely.
Todd, thank you. This is
Yeah.
wonderful. I'll make
Awesome.
sure. So if anyone's watching this replay, you're probably watching this on YouTube or one of the other platforms. We have some links. If you need any assistance, you can shoot us a message, shoot us an email, whatever it is. If you have any questions, we're gonna do this ongoing. So if you're able to jump on one of these. You just jump on the link and you can ask your questions here, and we're more than happy to help and just educate. We just want people to be able to grow, and we know there's a lot of information out there. There's a lot of different places you can go, but if you're coming here, you're gonna be able to be in the room where you can really have a conversation here. It's going to be really fruitful for you. So just want to say thanks, and yep, we'll see you next time.